Hi, this is John McClellan. Welcome to Where the Buyers Are 2010. I want to thank everybody for coming today. We're going to be talking about 2010 and what to expect where the buyers are. There were organic incentives and there were man-made incentives, i.e. the government incentives that are out there. The federal government put out a first-time home buyer tax about a year and a half ago, changed it up a little bit last year, so people get $8,000 if you're a first-time home buyer, if you haven't lived in a house for 3 years. That was a huge incentive for people who were first-time home buyers to go out and buy homes. $8,000 in your pocket, and there's still some zero-down programs available out there. The Fed started buying mortgage-backed securities a little bit over a year ago. By buying mortgage-backed securities, what they've done is increase the price of a mortgage-backed security, which decreases the yield, which drives our interest rates down. They've continued to do that. They were actually scheduled to stop this month because they reached their $1 trillion mark. They're going to go to $1.25 trillion in spending on this. That's trillion with a T. They've just decided to extend it to first quarter of next year. So through March of next year, they're still going to be buying mortgage-backed securities to drive those interest rates down. That's something we're going to talk about here in just a few minutes. I was talking to a friend of mine named Joe Farr, who runs MBS Quote Line here in town. He said that in September, the Fed's volume of buying mortgage-backed securities was 80% of the demand out there. What does that mean? Well, that means when they step away from buying mortgage-backed securities at the end of March and 80% of demand goes away, what do you think that's going to do to the price? It's going to send it down, which is going to send our rates way up. So another thing we need to be concerned about. We're going to be talking about that today too. Rental rates in lower priced areas around town have been very comparable to what you can get for PITI. It's another big incentive for people to go out. That's an organic incentive. When people figure out that they can buy a home for the same thing they can rent it for, or even cheaper, and sometimes they can use a USDA loan to get in for no money down, that's a huge incentive for somebody to go out and buy a home. The zero down program is still available on the USDA loans, and we've seen this and how it's relevant in some different price ranges. In a few minutes, we're going to be showing you some inventory numbers and around town, and one of them is Pflugerville. Pflugerville's got less than 3 months worth of inventory as of today. If you look at less than $299,000, I know there's not a lot of more than $300,000 houses in Pflugerville, but there are a few. There's actually 10 of them above that listed. I excluded it from that, but there's 2.9 months worth of inventory. If you looked at pending sales in Pflugerville right now, I think a lot of it has to do with the price point, and USDA is out there too. There's also a lot of incentives not to buy in 2009, and we see that reflected in the jumbo market. Jumbo price ranges have really seen, if not a flattening, a decline here in the Austin area, especially Westlake, Terrytown. Some of the Lakeway houses that are oversupplied have declining values out there too. In fact, we're seeing a lot of those on our appraisals. So there's actually a lot of incentives not to buy out there, but they're in different price ranges. Rental rates in those upper price categories are not comparable when it comes to PITI. If you're going to go buy $1 million house and you know property values are declining, you're probably thinking to yourself, what am I going to rent that $1 million house for in Terrytown? Mortgage payment's probably going to be about $8,000 a month. Rental may only be $3,500 a month. So you're probably, that incentive is really not there to go out and buy that house, especially if the prices aren't going up and if they're declining, which I think they are in a lot of areas. Jumbo lending's got real tough. That's another one that's it keeps people from buying. Mortgage insurance guidelines have really tightened up. We're going to talk about those today. The market news has not been the best. I think lately we've started to see some of the market news rebound a little bit. They're starting to talk about housing is doing better. How I think what it was, sales up 38% last month here in the Austin area from the previous year. I think that has everything to do with the first-time home buyer program and everybody kind of a rush to the door to get a contract in. I think we've been stealing a lot of these purchases from the future, by the way, this month and last month. The job market, so that's another incentive not to buy. Jobs have been disappearing even here in Central Texas. We're fared well than most places, but jobs drive housing, period. We won't see a true recovery until we see jobs. So what does this all mean with these incentives? Well, it means that the market's moved into three separate categories. Purchase prices above $439,000, and I'm going to tell you why that's important in a minute. Purchase price is between $300,000 and $439,000, and purchase price up to $300,000. Now, I'm sure everybody can probably guess why purchases up to $300,000 matter. On an FHA loan at a $299,850 purchase price, 3.5% down gives you our maximum loan amount on an FHA loan, which is $288,750. A lot of people are using FHA loans to purchase homes here locally. 3.5% down. USDA is a little bit below that, but a lot of people are using those too. Large buyer pool, and that's one of the things we're going to concentrate on today is that buyer pool. That's kind of a normal buyer pool right there. Purchase prices up to $439,000. $439,000 purchase with 5% down is what kind of loan amount? Anybody tell me? Josh? Conforming. $417,000. If you buy a house for $439,000, you put 5% down, you have a loan amount of $417,000, which gets you in conforming prices. So the reason I make that distinction there is because anything above that is going to have some downward price pressure to come down to that $439,000. If you get something around $450,000, $460,000, you're going to have some downward price pressure to get into that conventional lending. Jumbo lending, we're going to talk about that here in a second, is really, really difficult. In fact, I think my next slide is about jumbo markets. So these are the three: government, conventional, and jumbos. These are the three markets that we're going to be talking about today. Let's talk about jumbo loans. Jumbo loans are not done by any of the small banks anymore. There used to be a bunch of what we called Alt-A lenders out there. The First Magnuses and such, they've all gone out of business, either on purpose or been thrown in jail. Investment banks and portfolio lenders, i.e. a lot of your local banks, are doing the jumbo loans out there. We still have a number of investment banks out there like Chase and Citi and Wells Fargo who are doing jumbo loans, but it's really, really tightened up on the jumbo side. And this is going to show you why that buyer pool is so small. Remember, above $417,000 is considered DMAC, FHA, or anything. It's considered jumbo price. You have to have a 680 credit score now. Can't get a loan without a 680 credit score. 20% down payment is required on jumbo loans. Not 10%, not 5%, not 15%. 20% down payment on a jumbo loan. So anytime your loan amount's above $417,000, you're going to have to put enough money down to get to $417,000, or they're going to have to put 20% down to get it, to get the house. That buyer pool shrinks up even more. Most of the lenders out there require you have 6 months reserves, and they don't care about your retirement account. They don't even count that at all. They want 6 months cash reserves that you can go get if something happens. So 6 months cash reserves. Some of them require 12 months, and some of them, if you have other properties, they're making you have reserves for each one of those properties too. Interest rates on jumbo loans. The Fed is not buying any type of security associated with a jumbo loan. They are still following a little bit when it comes to what our conventional rates doing, but jumbo rates are about 1.5 to 2 points higher than a conventional loan. So if you're a buyer and you're buying at $450,000 and your rate's going to be 6.5%, and you know if you can get your loan amount down to $417,000, but you only have 5% to put down, and you know you can get a 4.5% rate if you go there, and how much that's going to save you on your payment, you're not going to pay $450,000 for a house. You're going to whittle that down until you're paying $439,000 for it to put your 5% down. That's why another reason we see a lot of price pressure in there too. And you guys going on your listing appointments, if you're going on a listing appointment and somebody's talking about listing their price more than you think it's worth and what they think it's worth, and they're around that number, that's a good tool to use and say, listen, you want to be where the largest buyer pool is. If you price this house at $475,000, people are going to have to put a lot of money down, and you're making that buyer pool real small. Why don't we price it right here, knowing there's going to be a little negotiation, that way opening it up to a larger market with better interest rates and less down payment. So something y'all can do on your listings.